the start of a new trading week and still massive gains being made in equity markets. The Dow surging at this hour, adding to record highs made on Friday for the Dow, the S&P, the Nasdaq, which is making some small gains right now. But this is ultimately what momentum looks like. Our next guest says that the market rally, coupled with a sector rotation and stronger dollar, is a direct effect of the election's thus far red wave, and leaves him with the question: should investors follow or fade this playbook? Joining us now to unpack the pros and cons, including a look at the macro themes moving markets this week, is Fidelity Director of Global Macro, Jurrien Timmer. Great to have you back, Jurrien. How are you?
Nice to see you, Pamela.
Delighted to have you join us, and everyone else can show their delight by sending in as many questions as they can over the next half hour or so. Okay, Jurrien, it's the first chance we've had to ask you about all of this. I know you've been traveling all over the world, but this massive repricing in the markets, I mean, just absolutely upended the tables here. Why has this all happened?
Well, as has been the case for several cycles now, the polls were wrong in terms of not so much the direction, but the magnitude of the outcome. And actually, I was going from Madrid, flying to Milan on election day, and found out the outcome the next morning. And fortunately, I didn't have to stay up all night. So I woke up in Milan. I was doing a bunch of client events, and I woke up like at 7. And shortly after I turned on the TV, CNN called Pennsylvania for Trump, and at that point, I knew it was over. So I didn't have to like waste any sleep time figuring this out. But we don't, of course, we don't quite know yet whether this is a sweep. They're still counting votes for the House races, but the general consensus is that this will be a trifecta of White House, Senate, and House. A pretty decent lead in the Senate, 53, I think 47, and then the House will be something like it has been in the past. And just the breadth of the win, I think, is something that required a repricing, because I would imagine that if people think that it's too close to call, it can go either way. Investors are not going to make a lot of investment decisions betting on an outcome if it's not obvious what that outcome is going to be. And so I think that's why you had that very severe repricing on November 6th. And if we pull up slide 1, so it was a rotation right into financials, energy, industrials, kind of all the sectors that would win either from deregulation or, pro-growth industrial policy, or even tariffs, right? That small caps are kind of intertwined with that. Obviously, crypto, I mean, Bitcoin's 85,000 as we speak right now. And you also had, small caps, and then you had higher yields. The 10-year briefly went to 460, and a stronger dollar. And those were all aspects of, the Trump trade, if you will, and we've discussed this in the past. And so I think my sense is that because everyone figured it was too close to call, people sat on their hands. And then, of course, the uncertainty ends, right? Because it was decisive enough that we don't have to worry about, like this is going to take for weeks like it did in 2000 with Gore Bush. And so I think that also was kind of a relief, maybe not a relief at the outcome, but a relief at that it was decisive. And so that's happened. So now the question is, do you follow or fade the Trump trade, and that's what we're here to discuss today.
For sure. And if we look at the asset classes that I think you have I don't know if that's slide 1, but just taking a look at the asset classes, and of course, Bitcoin being one of the stories of the day, to go through them there is just extraordinary, watching all of that. I mean, again, these are areas that had certain things baked into them and were allowed to run. But can we just go through those a bit specifically? Some of the top ones anyway.
Yeah, so you have Bitcoin, of course, at the top, Bitcoin sensitive equities like, MicroStrategy, companies that benefit from Bitcoin going up. Tech did okay, but the Trump trade is really, its financials because of deregulation, presumably, and also because the yield curve is more likely to steepen in a Trump administration because the Fed, is still cutting rates. Of course, it cut rates the very next day, which we've talked about, and which I think is reasonable because it's trying to get closer to neutral. Um,
Did it
but the
fuel
back
the
end
fire at all? I mean, just
was
because it was happening all within 24 hours of each other.
yes, yes, but it was it was in the price. It was expected, so there was nothing really unexpected in the Fed's action. But the back end of the yield curve, we call that a bear steepener, is moving up, and we'll talk about that as well because you're going to have more debt, right? I mean the if the tax cuts expire, I think that's supposed to add $4.5 trillion to an already $36 trillion debt. So higher long yields, rising term premia, very much part of the playbook. And I think that that would have happened either way, even if it was Harris. But that steepens the curve, and that's generally considered good for banks. So you get the banks, of course, energy. Trump, is pro energy, although energy production has already been on the rise. And then this notion of industrial policy, bring the supply chains back to the U.S. or at least North America, which obviously you would all be part of. At the expense of importing goods from other places, including China. That probably boosts small caps. So again, going down that list,
Yeah, look at small stuff.
those are the winners, and the losers are the bond proxies, utilities, real estate, things like that.
So this going through some of the pros and the cons that you see here. I mean, risk on is a pro, is it not? Or where does sort of
Yes.
the con piece of that come into play?
Yes. So let's go to slide 3. And so there are many pros. And for one, here's my election sort of roadmap showing the 2-year returns, annualized returns following the presidential election based on whether it was a sweep or some form of divided government. And again, here we're assuming that the House of Representatives goes to the Republicans, even though we don't know yet. So you go to the middle panel, and you can see like the odds are pretty overwhelming that even if it's a Democrat win or a Republican win, that a 2-year, like a sweep for those 2 years until the following midterm is generally positive. I think the odds for the Republicans are like 7 out of 8 that the outcome is positive. And so you have history sort of on your side. But again, it's not all a given. If we go to slide 4, we all know that the first 2 years of a presidential cycle tend to be sort of weaker than the last 2 years, right? And you see the last 2 years, of course, and my model based on down midterm years, what the election cycle looks like. I mean, it's that model has nailed the markets, right? I mean, it bottomed the week in October of 2022, that the market bottomed, and it's been straight up. But we're towards the end of year 4, and then we have year 1 coming up next year. And so even though, the sweep will mean more stuff can get done, it's not a given that everything that, the campaign has talked about will happen smoothly. We do have another fiscal cliff. Obviously, in a sweep, it's likely for the can to be kicked down the road, but the debt ceiling does loom again. And again, not everyone in the House of Representatives and the Senate are, MAGA, MAGA, disciples, right? There's still some like, I don't want to say rational, but like, moderate people in the Congress that are not just going to go along with any all plan. I mean, you think about like the no taxes on tips or bonuses, like like that has to be reined in. Otherwise, everyone will get paid as a tip, and no one would pay taxes. So and there's all kinds of fiscal offsets that need to happen. So that's all that requires congressional approval, And so it's not a slam dunk that everything like on January 21st, like all these things are going to happen. So it can get kind of gridlocked a little bit in that first year. And so usually years 1 and 2 are are emblematic of that, like as the sausage making in Washington starts to go. So it tempers the enthusiasm that all of this is going to happen right out of the gate. But countering that, you look at the market profile. Let's go to slide 6. Um, the market has broadened and has continued to broaden, I should say. 75% of stocks are above their 200-day moving average. And, we were talking earlier, my sense is that this is a reverse cycle in a way. So the bull market is 25 years old. Actually, let's go to slide 5 and show that. And, typically a bull market begins very broad and ends very narrow. And by that, I mean that, a bull market begins obviously after a bear market. Oftentimes those bear markets have down earnings, maybe recessions. And in those down cycles, the smaller, more speculative companies get really destroyed. And then they come roaring back, as a new cycle begins. And so you tend to see very broad participation in early cycle bull markets, and then they start fading away as the cycle matures. And at the end, you just have these blue chips, hanging out still. And this is why we look for these divergences where price goes up, but the number of new highs, for instance, starts to come down. But this one has been sort of the opposite of that, right? It started narrow with the Mag 7, the stay-at-home stocks, and that continued all the way until the middle of last year when the market finally started to look at sort of the light at the end of the tunnel for the Fed cycle. And so then we go to slide 6. And so it's only been since a year ago that the market started to broaden. And if you look at the little arrows there, those are the kind of things that happen near tops, where the breadth kind of makes lower highs while price makes higher highs. And that's a way of showing that the market gets narrow. And it's happening a little bit, but not in a meaningful way. So we've had a consistent period now since the last fall, that a majority of stocks are in uptrend. So this market cycle seems to be getting broader as it gets older, right? So that's a good sign. We want to see that, right? It's like the Benjamin Button market. And on top of that, if we go to slide 7, you can see just last week, and this really shows how much momentum there is. The top panel is the S&P 500 equal weighted index. That's a daily chart. And the bottom panel shows the percent of new 52-week highs and lows. And look at that thrust that we saw on the day after the election. That's the highest we've seen in a very, very long time. And so these are all good signs. The market's very efficient. And the hope, of course, is that this breathes new life into the earnings cycle. Slide 9, we have, kind of a report card on third quarter earnings season, which is wrapping up. I think 453 companies have reported. So almost everyone. And it's the typical stuff, 75% beating by about 700 basis points. Here you can see that the bump in the growth rate is about 500 basis points. So that's fairly typical. So the earnings momentum continues to be there. And if we go to slide 10, here I show kind of the squiggles of the annual estimates, the calendar year estimates. And 2024 is holding in pretty steady, about 9% growth rate. 25 is coming down, but that's fairly typical, but still looking at a double-digit growth rate. So the earnings side is lifting, is carrying the weight. And then it's a question of, what the fiscal policy will be, how much deregulation will matter, how much of that gets offset by tariffs, if there are any tariffs. And one thing worth remembering is that, the extension of the tax cuts is very much part of the plan. And my guess is that we'll see some form of that. The corporate tax cut from 2017, those were permanent. So there's nothing to sunset there. But remember that we live in a world where It's the flow, like the rate of change that matters rather than the level. So the extension of the tax cuts isn't necessarily a fiscal boost because people have been used to that now for, eight years. And for them to continue doesn't really change anyone's behavior, right? If they
Right.
were to sunset, that would be like a tax increase, even though it was just going back to the original. So it remains to be seen how much influence these policies in terms of taxes have on the actual economic growth rate. But generally speaking, the market's betting on a revival, and that could have
So,
implications for monetary policy and interest rates and all of that stuff.
so let's go into interest rates because this is sort of the question of what we saw the day after the election. Fed was meeting, and then decisions came out for another cut. Take us back to sort of the story of neutral, and deficits were always going to be an issue, we understand, regardless of which candidate won. So what does the Fed do ultimately with their path to cutting rates? Where's neutral? Where do they need to get to? Has that changed?
Yeah, so that's slide 14. Um, so I think, so we've been talking about inverted yield curves and recession now for several years.
Yeah.
And eventually it'll be a story again. But I can see it more being the opposite in 2025. And we talked about the liquidity cycle the last time, where some more growth and more fiscal expansion, whether that will actually bring inflation back, right? So this chart shows core PCE at 2.7, which is a good number. If you believe in the rate of change in terms of the level, people still have sticker shock around here. I'm sure in Canada as well. But it's moving, the rate of change is moving in the right direction. Fed wants to calibrate rates back towards neutral. So it doesn't even think of this as an easing cycle, which I think is fair. Fed doesn't want to be accommodative. It just wants to be less restrictive because inflation has improved and the labor market has been restored to balance, which is something we also talked about. And so it makes sense for the Fed not to be super restrictive, which is where it has been until it cut 50 basis points in September, and now it cut 25 last week. So we're now at sort of 4 5/8. My guess is that neutral is 4.
Really?
So,
Or, yeah.
inflation of 3, my guess is that inflation is going to stop making a lot of improvements here just because of base effects. So let's say 3 is the new 2. Neutral, R star, or real rates is about 100, maybe 150. And so you get to 4 as sort of the floor here of where the Fed should go if the economy is expanding and it just wants to be at neutral. And maybe it'll want to stay even a little bit higher than that to build in some cushion in case the economy sort of starts to overheat or what have you. But again, this is it's always a guessing game, right? I mean, R star is a theoretical construct that based on quarterly data that always gets revised. But just looking at historically what real rates are, looking at the TIPS market versus nominals, typically 100 basis points at least is a fair number of where the rate would be above inflation. So you get 3 plus 2 plus 1, you get to 4. So the Fed has a couple more rate cuts, but not much more than that. And again, a dramatic contrast to where we started this year. Remember when
Oh, my
the
goodness.
bond market had soared and the market was expecting 7 cuts just this year. So we're going to get 3, maybe a 4th in December. We'll have to see. But I think the Fed has to be pleased that it's been able to move towards the right direction, and it doesn't have to go to 2 or 3. The economy doesn't seem to really need it, but they don't want to make a policy error by being restrictive when it's not warranted.
Yeah, it's absolutely fascinating watching all this happen at the same time. A
Yeah.
couple of questions coming in about regions and where one should invest. Everything you've just said strikes me as this is just a moment for America in terms of the dollar, in terms of absolutely everything. Questions are, How does this impact ultimately your view on emerging markets? Is there a specific region, this is within the US, that would benefit from the Trump trade? Let's start with EM.
Yeah, I mean, again, it's always very alluring because EM is trading at probably a 60% discount to the US, and the US is getting more expensive. And it's obviously the dollar has been very, very strong. And if the Fed ends up cutting rates less than is priced in, and the pricing is already adjusting to that as we speak, then the interest rate differential between the US and other parts of the world will go up, and that generally favors, the home currency because currencies are derived from interest rate differential. Um, so it remains a difficult question that, you want the value, you want the relative valuation, but you don't want to fall into a value trap. So I think even within the US, you can kind of have the same playbook because in the US, it's growth versus value, large versus small. And the correlation of those two pairs trades, if you will, is pretty much identical to US versus non-US, whether it's EM or EFA. And by the way, the question I got the most when I was in Europe, right around the election, was, what does this mean for us in Europe? Like, are we going to be forgotten? And this or that. So my sense is that if you're in Canada and you don't want to bet against a rising dollar, um, you can have the effects of like an EM versus US trade just within the US by just going down cap, going into value, because they're all correlated in the same way.
Right.
But one good kind of follow-up thought on that, and we can pull up slide 13. And this, I think, is something that will be maybe a headwind for next year, or at least a caveat to thinking that next year can be a repeat of 2017, which was the first year of the first Trump
Right.
administration. Market was up like 30%, or just the last 12 months, which was up like almost 40%. And so maybe this plays into EM as well as a relative value trade. But if you look at the composition of or the deconstruction of the return in the S&P into an earnings component and a valuation component, and we've talked about this many times. This year has been very positive, very strong, because the market has benefited both from rising earnings as well as expanding PE multiples, right? It doesn't usually happen that way. And when it does, you get a double, amplified up move because you have PE sort of amplifying what would have otherwise been an earnings-based expansion. And my question is like, can that really repeat next year, right? So if you look on the left of that slide, we had a similar episode in the 2010s, and you had PEs rising and earnings also growing, but the PE levels were in the mid-teens, right? They were much, much lower. And so the hurdle now at a PE of 25 times trailing earnings or 23 times forward earnings, can they grow another 20, 30% next year from these levels? I think that's going to be tough to do. So in that sense, 2025 could really just be an earnings-driven expansion and not a valuation one. And that leaves some room for other countries and regions to catch up given their valuation story.
Wow, that is so interesting. Just because there has been so much growth through this year for a variety of different reasons, and into the last couple of days. A specific region within the U.S. that may benefit more than others.
Um, that's a good question. My sense is so, and think about industrial policy, bringing supply chains back to the US. That's going to produce some inflation. It's going to produce some wage inflation. How the immigration and the tariff policy kind of intertwines with that, who knows, of course, it's still early, but I would think you would go to the Rust Belt, and as those kind of regions, right? It's not going to be the coast. It's not going to necessarily be tech, although who knows what impact Elon Musk will now have on policy. But this is one of the reasons why the industrial sector is sort of in the playbook, because it's obviously he wants to use tariffs to bring supply chains back. And this is a populist president, and it was a victory for populism because both sides of the aisle are populist, and so bringing the kind of the average worker back is, I think, is very much part of this playbook. So I think a middle America type story is what the goal is. But again, what are the consequences of that on real estate? Like you've had this in Canada, right? That you population goes up a lot and there's not enough housing. So these are things that need to be thought out, and who knows if anyone's done that over here.
Tell us just a little bit about the story of the bond vigilantes. This is sort of the discussion of rates, really, and where rates lead the equity market in one direction or the other. You mentioned recently that the bond vigilantes are kind of back.
Yeah, so if we look at slide 15, and one of the reasons the Fed may not be able to cut as much next year is if the economy really sort of gets goosed up by this playbook and inflation maybe ends up stickier, then the Fed might have to kind of restrain the fiscal dominance to some degree. And that leaves questions about the back end of the yield curve. So this has been a bear steepener. Term premium has been going up. It's now 30 basis points, which is still low. But if you look at this chart, right, so the role of the Fed is definitely something we're going to be thinking about, not over the next 3 months, but the next 5 to 10 years. The debt since the pandemic in 2020 has grown $12 trillion. I mean, these are just incredible numbers. And at first, the Fed was absorbing a fair amount of that through its quantitative easing during COVID. But then, of course, it's gone into quantitative tightening mode. And so there's now a $10 trillion gap between what the Treasury is selling and what the Fed is buying. So it remains a very much an unanswered question. And then that gets you into the term premium, which is slide 16. The term premium is the risk premium for bonds. And by definition, a risk premium should be positive. That's why it's called a risk premium. And over the past, couple of decades, the risk premium in the US and elsewhere has been negative because of the heavy hands of central banks around the world. Zero interest rate, negative interest rates, quantitative easing, et cetera. Well, the QE days are over. And the zero interest rate days are over, and now the Fed, is at 4.5, presumably going to 4, but it's not, it's not hoovering up the debt the way it was. And so I think it's a very plausible argument to say this should require a term premium of 100, 150 basis points. And if we go to slide 17, my bond model, which I've shown many times, which shows that maybe 4% is fair value based on the forward curve and nominal GDP. If you adjust that for a rising term premium, you get to 4.5, 5, which may be an occasional tantrum above 5. And as we've talked about many times over the past couple of years, starting in 2022 with the big bear market, but even last year in October, it's been rising rates that have kind of caused indigestion for the stock market. And that's the Fed model. So slide 18, this is what Alan Greenspan always used to talk about in the 80s. But if you compare the bond valuation to equity valuation, equities need to compete with bonds because bonds are considered the risk-free asset. And so if bonds yield too much relative to equities, then the equity PE has to adjust to that. And it doesn't mean the stock market has to go down, because earnings might be offsetting that, but it can create wobbles and sort of, obviously the 87 crash was the classic example of that. And so the term premium is back. It's rising yields that, again, they don't have to derail the bull market, but they could slow it down. And I think for 2025, I'm looking at a positive market environment, an economic expansion that continues, earnings that are carrying price. But the headwinds to me are rising yields, and that's going to make it hard for the PE ratio to continue to expand the way it has. And that will, again, it will not reverse the bull market, but it will slow it down. And that's kind of my overall theme for 2025.
There is a lot of meat in what you just gave to us after we've been watching these markets just skyrocket over the last several days. Very grateful to you, Jurrien Timmer. Thank you for joining us, and continued travels, safe travels. I know you'll be with this
Yes,
crowd next week.
I'm off to Chicago this afternoon. So.